Welcome to the Balance Sheet, where you rise above the noise and learn about the most important business issues of our age. I'm your host and fellow student, Conrad Chua. Many business school students are interested in working in finance, but many of them only think of working in financial institutions. But there's actually a huge number of opportunities to work in the finance functions of companies. Finance is like the beating heart of a business. Today's guest is Harsh Mohta. Harsh is the Senior Finance Manager at Here Technologies in Amsterdam. And Harsh has worked in several companies of different sizes and seen firsthand how finance can make huge changes in those companies. So welcome, Harsh.
Thanks, Conrad. Happy to be here.
Harsh, could you tell us a bit about your background and how you got into finance?
Yeah, of course. Honestly, ever since I was very young, I knew I always wanted to go into finance. My dad was in finance, and it almost felt like hereditary for me to, sort of join in his footsteps and continue being in finance. It helped that I was very good with numbers as well, so it felt like a natural career path. So basically, when I got done with high school, I did what every young kid in India does who wants to go into finance. I pursued a chartered accountancy course. I did that. I qualified to become a chartered accountant. Worked for about 5-6 years, which is when I decided to come to Cambridge to get my MBA. I think the one thing that I did realize, which also sort of prompted my move to go for an MBA experience, was I was always surrounding myself with very similar people, people my age in finance. And I was apprehensive that I might have a very, myopic viewpoint of looking at things. And I really wanted to understand the full breadth of how, for example, things run, what other people do, what are the different kinds of, experiences people have. And that's what led me to doing my MBA as well. That was definitely one of the bigger reasons.
So before we go into the companies you work for, what is the difference from your perspective of someone, when someone's making a decision, should they be a chartered accountant, go do an MBA, or even a CFA? What are the differences in those three paths?
I think having done the CA and then the MBA route, I think MBA is not any other finance course with MBA is not really binary. It's more It's more supplementary. So for me, once you get sort of the really thorough knowledge that sort of more specialized finance courses like a CA or CFA have to offer, and then to hone and sharpen your skills and sort of broaden your horizons, get more stakeholder management, general management principles. That's when the MBA really comes into play. Because even today in my career, I use a lot of what I did from my CA, but also a lot of the things that I learned during the MBA program as well. So I think it's really CA plus MBA in that sense.
Okay. So you came out of high school, went to university, did your chartered accountant. Then what were you? What was going through your mind when you thought about, well, where should I work?
Yeah, for me, I mean, I was studying to become an accountant, and in India, when you do the CA, you really need to. One of the mandatory parts of the course is that you need to work full time for 3 years at an audit firm. So for me, it was, I needed to do it at an audit firm, and when I started researching, okay, this is back when I was 18 years old. I had no idea about any companies, any firms, so just went on Google. Okay, what are the best places to work for? Then I came to know what a Big Four firm is, sort of the history, how important it is, significant they are, and then that's when I decided to start my career with Deloitte. So I started my career with Deloitte, and then between Deloitte and EY, I spent almost 7 years of my career doing work with Big Fours.
Were you doing audit accounting for both Deloitte and EY?
Yeah, so I started doing audit insurance when I moved to Deloitte. I did that for about 3 years, and then I moved into transaction services, M&A, and due diligence. So basically, a lot of what I learned during audit had a lot of transferable skills, and M&A is where I wanted to be at that point in my career. So I decided to move there as well. And honestly, for me, Big Fours, especially if you're early on in your career and just starting out, Big Four for me is like a school after school, because it's almost like a finance boot camp. There's so much learning opportunity, incredibly detailed oriented work. You're really digging into the numbers and covering insights, sometimes finding some skeletons in the closet somewhere. So it really teaches you a lot, and it's really very good to get your basics and super good.
I see a lot of students who apply to the MBA and they've got transaction advisory as part of on their CV. Can you tell us a bit more about what that means?
Yeah, so transaction advisory is basically, think of it like a larger umbrella, and you have different sub work stream underneath it. So you have due diligence, whether it's financial due diligence, commercial due diligence, technical due diligence, whatever that may be. You have sort of more lead advisory or investment banking. You have your restructuring and turnaround services, and the fourth one is more valuations and business modeling. So most Big Fours, when they call out transaction services, transaction advisory or deal advisory services, it's basically a combination of these four sort of sub-services. Yeah.
And can you give us a sense of the kinds of projects that you were doing when you were doing transaction advisory and M&A?
Yeah, so I did transaction advisory both in India as well as in Amsterdam. So I got an exposure to a wide variety of deals. I was specializing more in sort of commercial real estate and SaaS sectors, but it's basically typically if it's on the buy side, there's a private equity fund, or there may be a strategic company that has already identified a target company that they want to either acquire or invest into. And once they've had that pre-deal identification done and they've signed a letter of intent or a term sheet, that is when they would typically come to a Big Four and say, okay, I wanna invest company A. This is what I want to value the company A at, and then start sort of a backward-looking exercise for the past 3 months. We look at, what are the three over the last 3 years, how the financial performance has been. Are there any adjustments to the sustainable quality of earnings? Whether it's, there are certain one-offs, there are some non-recurring elements. There's some elements which are really going to be deal breakers. And the ultimate output of the due diligence exercise is really identifying what are the adjustments to the EBITDA, and therefore what that would mean for the valuation as well. And in general, just providing comfort to a potential investor.
Yeah, we'll come back to those kind of the work that you just described about making adjustments and EBITDA later on. But so you've been going back to your career. You finished 7 years EY and Deloitte. Was that when you started thinking about doing an MBA?
Yeah, so that was basically when I started to think about doing an MBA, right? Because like I said, I was always, even when I was doing transaction services, right? It was my colleagues were in finance, my clients were in finance, the companies that we were looking to acquire also from a financial lens. So it was, I was fearing that I might have a very myopic viewpoint of looking at things and not really understand the breadth of how companies run, for example, how other services and sort of other, whether it's operation strategy, how they come together, which is when then I decided to pursue an MBA, and I moved to Cambridge to do that.
At Cambridge, the MBA is 1 year long, and it's a general management degree, so you're not just doing finance, right? You've got some finance core classes, electives, but you've also got strategy, marketing, etc. Now that you've left Cambridge for a period of time, what were some of the non-finance things that you learned that you find applying even 3-4 years after the MBA?
I think the biggest, one of my biggest takeaways from doing the MBA was just perspective and stakeholder management. And what I mean by that is, my cohort, and I think all cohorts before and after mine, have people who've excelled in whatever walks of life they've been part of, and it but their understanding or their area of expertise, like mine, were limited to their roles, right? So for me, what I realized was finance professionals tend to be very jargony, for the lack of a better word, for example. And the way that we describe things, or the way that we describe may be too technical for non-finance people who are not very conversant with the financial terminology. So that's during the MBA is when I first dawned upon this realization, and it really helped me a lot when I moved into when I moved out of a big four and I moved to within a company where I had to deal with a lot of people from sales, from people from product management, and I had the experience from Cambridge to be able to better translate what I was trying to say to people who I knew how to soften the language, and I knew how to position in such a way that it's understood by non-financially literate people as well, for the lack of a better term. I think that was a very big takeaway that I consistently see myself applying within my work.
So you finished MBA, you had a degree from Cambridge. What did you do then?
For me, one of the reasons also to choose an MBA either in the UK or in Europe was because I wanted to move to those geographies. So once towards the end of the MBA and when I started recruiting, I found Amsterdam really the place that was really my calling, in terms of the city is beautiful. It's one of the few places in Europe where English works as a business language, so it didn't deter me from not knowing any other European languages. The tax structures that are there for expats are really well, and a lot of the EMEA headquarters for a lot of companies are also in Amsterdam. So a combination of all of these factors really made me gravitate towards Amsterdam, where I ended up moving.
And can you tell us a bit about the companies that you've worked?
Yeah, so once I was done with my stints at Big Four, right, and I think for me, that was really an expiration point that I felt for Big Fours, and that's not to say that other people feel the same way, but for me, I thought after a certain point of time, I always felt like I was on the outside looking in, and sort of really lacked the end-to-end visibility of what my actions or my analyses really meant for the larger scheme of things within the business that I was either advising for the acquisition of, or helping divestiture, or so on and so forth. And basically, this sort of really prompted me to move to within a company and move to the industry. So that's when I decided to move to EV Box, which is a Dutch-based global manufacturer of EV charging stations. So I moved to EV Box basically as a manager of their commercial finance practice, and soon also my scope of work evolved to include the entire scope of FP&A and business finance.
And you're now working at a different company, but still in Amsterdam.
Yeah, so I worked for EV Box for about a little over 2 years. It was a very good experience. EV Box when I joined in was in a very classic scale up situation. The company had been growing consistently year over year. I think almost double digit growth rates, and the enabling functions, among them finance, was still playing catch up. So for over the course of 2 years, did a lot of transformation work as well, building out Tableau dashboard landscapes for better visualization and insights into the actual data, setting up oversight boards for from a commercial finance standpoint on when we were submitting large value tenders. So a lot of intensive work, but super rewarding nevertheless, because I had an end-to-end visibility of what the impact of my analyses were, and that decisions were being taken sort of very sometimes even solely based on insights that I was providing. But a few months back, I now moved to a new company called Here Technologies, which is it's a 40-year-old incumbent in the navigation technology and spatial intelligence space, where now I lead the long-term financial planning of the company.
And I think you've given us a bit of flavor, when you're working for like a big four, you've got these quite structured sort of processes and a big machinery right behind you. And then when you went to EVBox, is it the case really you're the one setting up the systems?
Definitely. I mean, in a startup or a scale-up kind of environment, right? There's no set processes. There are no structured ways of doing things. It's very entrepreneurial in that sense, where you're really welcome and you're really motivated by the company to actually really start new things, set up processes, set up systems. So when I came in, like I was saying, when I joined, one of the first analyses that I had to do, I started looking at the details that I had, and I realized there was an asset register, there was a manually maintained Excel file, there were data sets in two different ERPs because there was an ERP migration at some point, but the ERP migration was also rushed, so the quality of data was I was skeptical about that. So it was there are informations, there's data, but it's all scattered and it's cluttered. So data quality really becomes a big issue, and even outside of that, I think a lot of things are sort of still being built up as a company sees a particular things. For example, on how to deal with warranty or how to deal with tendering process, from trying to maintain margin preservation, gross margin preservation. So these are the kind of things that it really being set up, and I was very fortunate to have had that experience of setting that up.
So you came from quite a structured environment, right? And you were from India, you worked in India, then you go into this foreign country and you go get into this company and you find, oh my gosh, there's all this stuff that I took for granted before, and now it's all over. How did you mentally approach this? To try to clean this up?
Honestly, you're right on the money, right? Because it was a cultural shock for me when I came, because when I'm in a big four, typically the clients who work with big fours, or if I may say differently, the clients who can afford big fours are technically more established companies. They've been for a long time. They have structured processes. They have robust data sets, and then the way of working is very structured. And I was always expecting that. And even when I was in big fours and we were with clients that did not have the quality of data, that we would sort of just caveat it and saying, well, we can't comment on it because we don't have the necessary data to do that analysis. But when you're within a company, you don't really have the option to do that, because the analysis that you need to do is really fundamental to the company's future and the company's viability. So it was really about, okay, let's take a step back. What do we have? How can we find workarounds? How can we find rules of thumbs? How can we brute force certain things together to make sense of it? And then really doing a lot of workarounds to actually figure out how to get the best foot forward and how to run the numbers and make the analysis that needed to be done.
So how did you go about thinking, well, what are the key kind of drivers in this business that you think is very important, and hence you want to start there to get proper data, proper systems, so that you get a handle on what's going on? How did you figure this out?
I think trying to figure out the drivers of a business, it's really about developing curiosity and learning to connect the dots. Like, I think it really starts with the basics. The first thing is, I would say, understanding the product and service. So if you don't know what your company sells, who buys it, why is it important, then you're never going to understand what drives growth. I mean, for example, at EVBox, I really had to learn not just about the EV chargers, but also just the broader trends in the electric mobility market, how the policy incentives are going, how the regulatory landscape will go. And sort of for me personally, I felt if I'm going to be in commercial finance and I'm going to lead the go-to-market finance strategies, I need to be well versed in this. So I kept reading, I kept trying to find podcasts, trying to find online resources, talking to the people in strategy teams, and and it kept doing that to a point where I attained almost a primary SME status in terms of market modeling, competitive intelligence, and go-to-market stuff within the highly matrix business that EVBox was in. So I think that understanding the product service is definitely one. The second thing is really talking to the frontline team. So as enabling functions, or a lot of times in FP&A, that there are professionals, FP&A professionals, who think it's a finance exercise as opposed to a business exercise. But for me, a budget, a forecast, a financial model is just the finance holding the pen, but it's really the company's model. So talk to the sales team, the operations team, the customer service team, the after sales team, to really find out things that you're not going to find out just by looking at numbers on a spreadsheet. Sometimes a conversation for me with a product management team would help me identify what the pricing issue was, which was eating into the profitability, for example. And last, I would say, is just diving into the data patterns, because numbers don't lie, but they do need a context. So I believe I've always felt that judgment or conclusions should be based on data and not just on vibes or feelings. So it's about trying to pair that intuition with investigation.
So this sounds like it's quite a different sort of work from what people, as you say, what people associate with FP&A. Can you just explain what does FP&A stand for, and what does it mean in a finance context?
Yeah, so FP&A basically stands for financial planning and analysis, and what the role encompasses is in the name itself. So you plan for the financial performance, which is either you do a one-year budget, which most companies do. Most companies also have sort of a multi-year view of things, whether it's 3-year or 5-year long-term planning, multi-year models. And this third thing is sort of more forecasting, which is, from my perspective, an iterative process, and you keep sort of truing it up or truing it down with actuals and then reforecasting it. And then on the other side is the analysis of the actual performance. So you set the goalposts in terms of what the plan should look like or what the budget should look like, and then you need to compare the actual performance with what you had planned for, and understand what drives the variance. Why was the sales flat as compared to our expectation of plus 10%? Why did the margin leak 2%? What drives the increased cost? So that's the second leg of the FP&A.
And we've got a comment here. I think it from someone who's actually on one of our programs here in Cambridge. He says, or he or she says, it's about connecting the dots in the data. It's about telling a story, telling the results to decision makers or upper management who may not understand jargon or numbers. I think, Harsh, you mentioned that already before. What do you think, when you see people in finance, what do you think people who are in finance get wrong when telling the numbers and the story? Not just about the jargon, but what is it that trips them up when they are explaining things to decision makers?
I'll give you a funny example with that, right? One of the years we were sort of on the towards the fag end of our planning window, right? And we were just finalizing the budget for the next year. And there was a question that one of our C-suite members asked: why is the cash need going from X to Y? And then I asked the analyst on our team, okay, why do we have an increase of 10 million, whatever that number was, in the cash requirement? And then, because we've modeled AR taking 30 days instead of 60 days, and our days of sales outstanding changes. And that's a very technical answer. I cannot go back to a C-suite member and say that the model mechanics is the reason why your cash need goes up by 10 million. I think what I'm trying to say by that is, a lot of the times the reason for variance or the reason for a certain thing being a certain way is answered by a certain finance professionals in a very technical term in terms of what the Excel says and not really what are the drivers behind why that is moving in a certain way.
Okay. And you mentioned Excel a bit. Do you, I guess Excel has been driving quite a lot of the kind of planning and finance in many companies for years and decades, such that nowadays when we look at it and we see something's in Excel, alarm bells should alarm bells start to go off if you start finding companies having data in Excel spreadsheets?
I mean, so yes and no. I think data should. I mean, most companies today have very or at least even from a startups to a scale up stage, people are now employing more and more ERP systems. There are certain ERP systems that are very cheap to get. They're online available. You don't necessarily. So it's an easy way to start having them on your ERPs as opposed to on Excel. But a lot of the analysis that happens outside of just the bookkeeping part of the finance is still done in Excel. For me, I still use a lot of Excel to run all of my financial models. Yes, they're a little bit more advanced than when I was starting out in terms of sometimes they're directly linked to Snowflake or to other data repository systems. Sometimes they're automated, but ultimately a lot of the analysis still happens in Excel. So I wouldn't be too worried about company having a lot of their stuff on Excel.
And we're almost at the half-hour mark, and I have to throw in the word of the last 2 years, which is AI. How do you see finance functions using AI? What are some of the use cases that can be that are really powerful?
That's actually a very good question because, and at the risk of giving a boilerplate or a very generic answer, I think AI is definitely the question is when, not if. But for me, the proof of the pudding is really in the eating. I've attended a lot of FP&A workshops or seminars for FP&A professionals and for finance professionals over the last couple of years, and definitely AI is a very strong topic in a lot of those discussions and forums. But I've only really seen isolated examples of AI being used in finance. So, for example, I was in an event earlier this year where a business controller from Heineken was speaking at that seminar on how they had used AI and ML to identify certain markets and avenues for their marketing initiatives to really increase their return on ad spend based on multiple years of historic data and millions of data points. Basically, okay, these are the 2 or 3 kinds of advertisements, and for these markets, and this is how we need to optimize. So that was a very interesting workshop that I was part of. But honestly, outside of these isolated examples, the widespread use of AI has not really happened in finance. I think it's really because no one wants to be the first idiot, if I can say it that way, because you in businesses, you have a first mover advantage, but I think in deploying AI, you can also have a first mover disadvantage, as many companies have learned the hard way with sort of some of their employees putting sensitive information on the chat GPTs and copilots of the world, and that being available for in public domain. So that it's AI is coming, but I don't think it's fully there yet. If I were a betting man and I would stand here today and try to see what would really be the low hanging fruits in terms of how the deployment of AI could happen in finance, I would say it's either going to be in predictive analysis for the forecasting and budgeting, or it's really going to be on process automation for sort of more manual exercises, your invoice reconciling, accounts reconciliation, matching invoices, those kind of things.
Sorry, it's basically things that are high volume but kind of low risk if things go wrong, isn't it?
Yeah, exactly.
We have a question from Pavel who asks, do you have any structured system of databases, data that you systematically collect within and outside your company? So when you get into a company, what are the key things that you try to systematize and collect?
Yeah, so for me, it's whenever when I started with my new company, one of the first things I need is I need access to the ERP system, because a lot of the times I need to be able to retrieve them myself. I need access to the data visualization tools that they have, whether it's Tableau, Power BI, Alteryx, whatever the company uses. Or hopefully most companies today use that, so it's not about whether or not they use it. And then depending on the role in finance, it will change. Like for example, when I was doing more commercial finance or go-to-market finance, I needed access to Salesforce as well, to really understand how the opportunity flow into the pipeline and the backlog is happening. And ultimately, today a lot of companies use data repositories as a single, for the lack of a better word, warehouse, where all of their data is stored and refreshed at whatever frequencies, most of the times daily, and sort of having that access to that information flow as well.
I don't know if this is kind of in your expertise, but someone on LinkedIn is launching a medtech startup and asked, should they use public or private equity?
I mean, not entirely my area of expertise, but if it were me, I would probably go the private equity route, because there's a lot of private equity or venture capitalists that have sectoral focus, and medtech is really one of the avenues that's been getting a lot of traction from a lot of investors. So probably the latter than the former.
Harsh, you're also very active on LinkedIn, sharing your thoughts about finance, things that people should be looking out for in finance. Uh, you had a recent post about how to prepare company budgets, which is something that everyone in finance has to do at least a few times a year. What is it about this trilemma of time, cost, and scope, which you talk about?
Yeah, so I mean the trilemma that basically the post that you're referring to, right? So I was talking really about what's called the iron triangle in project management, which is basically trying to balance time, quality, and cost. And specifically, and I tried to imbibe that in the budget process as well, especially because we're now towards the end of the year, and we're just about finalizing our own budget in the company for the year to come. But basically, it's really when you're doing any sort of activity, for example, you're building your budget or your forecast, it's really a balancing act for three different factors. So it's time, it's quality, and cost. Time is basically, we we all race against the clock in the budgeting process. There's strict timelines you need to have. You need to be adhering to those timelines. You need to have your level of reviews. You need to have interlocks between your different divisions and your different departments within the company. And it's really how fast can you make sure you have the accurate data and the accurate planning to meet those time deadlines. The quality is, or let me come back to quality afterwards. So the cost is basically how much do you invest in your resources, in your technology, in your people to get the job done. And the key to really achieving high quality results without blowing away the budget. And then the quality is really how detailed and reliable your forecasts are. It's not just about getting the numbers out on time, but making sure they actually do reflect the business reality and the accuracy. The challenge really is trying to find the right balance between these three, right? Because more often than not, we're always forced to make trade-offs. So, maybe you have a lean team, and you have a very, very strict deadline in terms of how the budget's going to be. But then, so you have low cost, you have low time. That means your quality will unfortunately have to suffer. It might not be the most optimal. Let me put it that way. So it's really about trying to manage this triangle. And from my perspective, having that level of transparency with with your stakeholders, everyone involved, and just making sure that they're aware of the potential trade-offs that are there between time, quality, and cost. You can manage those expectations and not really have surprises at the end.
I think everybody has had the experience of having to submit a budget estimate to finance. And people always figure out, well, let's try to play this game. Do we tad 20% on expenditure just because finance is going to cut us down 20%, these sort of gain. How do you sitting in finance trying to prepare a budget that's robust, that's quite reflective, get around all these tricks and games that people might play?
Yeah, it's funny because I remember when I was at EVBox, we had this team event, or we had this company-wide event, and one of the things was we had to draw something that represented other teams. And for our team, someone had drawn a police shield or a cop shield. Basically, like we're the one enforcing, we're the one telling people they can't spend, we're the one telling people they can't offer very high discounts. So really, it was very amusing to see. That's what the company was thinking of how the FP&A team works. But honestly, in reality, it's just trying to make sure you have an optimized cost base for the direction that your company is taking, right? So if you have sort of a hockey stick in terms of how your revenue is going to scale up substantially over the next 3 to 5 years, well then it's likely that you need to invest a lot into your OpEx and to your CapEx to make sure you're fit for purpose organization to really achieve those kinds of revenue numbers that you want. So it's really about trying to have that level of balance. So if for example I was doing, let's say I'm trying to see for the sales and marketing team what their cost should be, and they say, okay, we don't have enough people, then okay, if you don't have enough salespeople, you want to go hire more salespeople. What is the yield per each employee that you can generate from salesperson? This is what our competitors are doing. If we want to be in the upper quartile of what the industry is doing or what our competitors are doing, then this is X million is what each FDE should generate. So then having sort of those drivers or those allocation metrics to really make sure that you drive that delicate balance.
Christopher on LinkedIn asked, right, you can only choose 2 out of 3, right? When you're looking at a budget, quick, fast, or good, you can only choose 2, or sorry, cheap, fast, or good. Which one should you choose?
A very tough question, because it really depends on the company. Because okay, you have 2 choices out of quick, fast, and good. Okay, I think it would
cheap,
be
fast, and good. I think it's cheap, fast, and good.
Yeah. Okay, yeah. I think cheap and good.
I think okay, so you rather take your time, is it?
Yeah. I mean, short answer, yes, but I think long answer is you can get to 95% accuracy in a certain amount of time, and then from that 95 to 100 takes a longer time. So it really depends on what's the level of accuracy that you really want to go to. Are you satisfied with a 95% accuracy, or do you think that incremental 5% is really gonna change the company, or is it directionally, is it okay? So it's really a very personalized thing.
You mentioned about how people in finance should drop the jargon, think about the stories when you're talking to decision makers. How should your sales and marketing teams or the production side, operation side, what is your suggestion for them when they talk to you in finance, right? So that both sides can work better together.
I think the one thing that I realized, especially during my time at EVBox, was that there needs to be transparency, and on both sides. So, for example, there are certain companies that do not share the cost profile of their the cost profile of their products to the salespeople. So you can't expect your salespeople or your commercial organization then to be very good with their margin preservation in the pricing that they offer to the customers if they don't know what the margin that we're going towards. So it's really a two-way street. You need to make sure you're transparent as a finance professional or a finance organization. You're transparent enough to the rest of the company, so that in turn they know the goalpost that they're working towards and what they do is really going to have an impact on either the gross margin or the EBITDA, whatever the metrics that you're looking towards.
So you mentioned EBITDA, which is obviously one of the first things that a new business school student learns when they come to, whether it's corporate finance or accounting. So you've also written on LinkedIn about the work that you did in transaction services, about quality of earnings adjustments to go from EBITDA. Can you just tell us very briefly, it's like a corporate finance 101, what are these quality of earnings adjustments that people have to do?
Yeah, absolutely. So basically, quality of earnings adjustments is really trying to let me put it this way, strip away the noise so that it shows on a sustainable level what is the profitability that the company might generate. So for me, it's really basically three key items that you need to look for. One is non-recurring items. So these are incomes or expenses that are really unusual. You don't expect them to repeat. Think of if a company A sells the building that they own or they have their office in for 5 million euros. It does boost the earnings for that year, but unless the company is actually in the business of buying and selling of properties, it's not part of their core operations, and it shouldn't be factored into ongoing performance. Then second is your one-off items, your really sort of aberrations or points in time that has happened, but you don't expect them to happen. So let's say there was a legal settlement or a lawsuit that you settled, that a company settled for, I don't know, 10 million euros. It's a material expense and it does change the cost profile for that particular year, but the company is not expected to have litigations or legal settlements every year. So then you would add back sort of the 2 million to your EBITDA. And the last really is what I call pro forma adjustments, which is basically these are sort of adjustments to reflect how earnings might look under different circumstances. So for example, if a company recently acquired another business, and if you're looking at the 3-year horizon period, so you'll only see what the aggregate profitability of that company is in the 3rd year, but in reality, you add back in the first 2 years as well to show, okay, like for like, how much does that acquisition really add to the profitability of a company?
Am I right that many of these adjustments, they're not cut and dry? Are they all cut and dry, or is it some subjectivity to it?
No, it's really it's a mix of art and science for sure. Because like when I started transaction services, and one of the first questions, if I had I'm not sure whether this is an adjustment or not, I would go to a senior manager or director in the practice and ask them. They would be like, are you on the buy side or are you on the sell side? So a simple question is like, okay, like how extreme or how really stringent you want the adjustments to be. Because the examples that I gave were really very, very cut and dry, but there's a lot of examples where I could argue for both sides. So it's at the end of the day, it's all a negotiation, what a buyer wants to pay for and what a seller is willing to accept for it.
Well, thank you so much, Harsh, for lifting the hood on how finance works in different types of contexts. It's very clear that it's not just the kind of cut and dry, as you say, that you learned in Corporate Finance 101 in business school. And I also hope that our listeners would have been inspired to look at the finance team in their companies in a different way. They're not all just the cops. And hopefully you can have a better conversation with your finance team the next time they ask you for inputs to the budget. Thank you also to our viewers for all the questions. The balance sheet will be back on the 29th of November. It's a slightly later time of 4:15 p.m. UK time. We have Talbot Stern talking about how to raise your management game and become an elite performer manager. There'll also be an announcement about the live stream series at next week's session. So make sure you join us then to hear about it. Well, till then, stay safe and we'll see you